Welcome back to Alpha Recap, the weekly wrap from stockalpha.ai. Great to have you with us. Nate here. And today we're unpacking this week's big themes from over 300 research notes. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks, Nate. Excited to dig in. There was a lot to sift through this week.
Let's lead with the headline. Three dominant narratives emerged: AI and data center demand, a tilt toward income and regulated cash flows, and a sharp valuation tug-of-war between beaten-down names and premium AI beneficiaries. So, what really stands out here is how those themes are colliding across sectors.
Totally. The research highlighted AI as a cross-sector growth lever, but analysts kept reminding readers that high expectations mean limited room for mistakes.
Before we jump deeper, quick reminder, everything we discuss is informational only. The analysis and numbers we quote are from Alpha Research Notes. This is not a recommendation to buy or sell any security.
Right. Analysts note the data, and they model scenarios, but they stop short of tailored advice.
Okay, let's start with AI and data center momentum. The research reiterated that NVIDIA sits at the center of the compute stack. The notes flagged robust fundamentals and accelerating data center revenue. NVIDIA's shares were trading at about $188, and the company's market cap was described as roughly $4.6 trillion in those notes.
Analysts framed NVIDIA as a primary beneficiary, but they repeatedly warned about the valuation premium. The idea being momentum is real, but execution sensitivity is high.
And that momentum ripples out. Semiconductor equipment names. Think of the big lithography and test equipment suppliers. Plus the semiconductor ETF that's been trading near its 52-week highs, all showed up as net beneficiaries of AI capex.
Exactly. Research on the semiconductor ETF called the sector high beta, strong upside when orders accelerate, but also exposed to supply chain and capacity swings.
So, what really stands out here is how AI demand showed up outside pure semiconductors. Industrials, data center real estate, testing and cooling companies all got mentioned. The common metric was capex and multi-year lease demand from hyperscalers.
I mean, when you step back and look at this, AI is almost a demand multiplier across infrastructure. The research cited data center lease roll-ups, rising GPU orders, and multi-year contracts as key indicators.
Quick reaction segment. Let's pivot. Income and regulated cash flows was the second big theme. Analysts pointed to utilities and regulated names for steady dividends and visibility. PPL's grid modernization plan came up, roughly $8 billion of planned investment, and Pacific Gas and Electric's long license renewal at Diablo Canyon was described as de-risking.
Right. And the other thing is that investors traded some volatility for the certainty of regulated earnings. The notes highlighted dividend yields and predictable rate cases as real attractions versus high beta AI plays.
Banks and regional financials showed up in that same income conversation. Analysts pointed to metrics like price to earnings, dividend yield, and buyback programs. But they also warned about deposit and credit sensitivity ahead of first quarter earnings prints.
Yeah, that tracks.
We should underline the valuation bifurcation, the two-speed market. On one side, you had premium AI leaders trading with lofty expectations. On the other, fallen growth and cyclicals that look cheaper on paper and may offer yield. Analysts used examples like a payments company that traded down to roughly 15 times earnings after a big drawdown, and a real estate name with solid free cash flow but a re-rating lower.
Analysts stress that premium multiples mean little mistakes can be punished. Conversely, value names carry execution and cyclical risks. It's a balance between potential upside and safety of cash flows.
Let's call out some specific notable company highlights from the notes. Eli Lilly reported a win with Foundeo, an oral GLP-1, and expanded through an acquisition. That put Eli Lilly's shares at about $939, with a price-to-earnings ratio of roughly 43 times in the research snapshots.
That approval was a material regulatory win. Analysts liked the fundamentals, but flagged payor and reimbursement risk as a key caveat.
Honestly, I was a bit surprised by this one.
It was surprising in how it amplified expectations and reminded analysts that drug approvals shift attention immediately to pricing and coverage questions.
Globant popped up twice in the coverage as an example of a company that's seen a valuation reset. Notes put its share price in the mid-40s in different snapshots and a price-to-earnings ratio around 18 to 20 times. Analysts flagged the classic value versus execution trade-off there.
And the message was consistent. There's AI and M&A optionality, but near-term growth stagnation and margin pressure could keep a lid on an easy re-rating.
Cybersecurity and cloud security were also recurring. Identity and network security names were described as having steady secular demand, but some still had negative GAAP earnings and stretched multiples.
Analysts balanced product momentum against valuation and profitability. In other words, strong top-line demand doesn't automatically translate to margin expansion, and that was a recurring watch item.
Crypto miners and infrastructure players got a fresh spin this week. Several reports argued some miners could pivot from episodic Bitcoin revenue into recurring AI hosting revenue, but analysts labeled that contrarian and execution heavy. The miners often carry heavy leverage and negative earnings right now.
That's a big if. The contrarian view treats negative earnings as temporary if companies can secure long-term colocation leases with hyperscalers. But analysts warned to watch cash runway, lease confirmations, and leverage closely.
Short reaction segment.
Right.
Now, patterns and connections. First, AI showed up in odd places. Industrials like large oil field services and conglomerates, data center real estate investment trusts, testing and cooling companies, even logistics owners who are selling land for hyperscale campuses. The common thread was capex intensity and long-dated leases.
Which means analysts are tracking GPU shipment disclosures, equipment order flow, and data center leasing activity as high information indicators for the theme.
Second, valuation bifurcation. We covered that. Third, the research emphasized event and flows-driven near-term. Buybacks were notable. Qualcomm's announcements were called out as a big capital return item, and ETF flows into semiconductor exposure and energy were shaping sentiment.
Exactly. Analysts flagged that ETF inflows and outflows, and technicals like 52-week highs and lows were first-order drivers of short-term price action.
Risk concentration got a lot of airtime. Regulatory moves, like drug tariff discussions, geopolitical tensions in shipping choke points, and liquidity strains in small caps were recurring red flags. That part of the tape felt heavy.
It was heavy, yes. Analysts were explicit. Policy shifts or sudden geopolitical events can multiply risks for both cyclicals and growth names.
We should call out the contrarian takes the research surfaced. One was the miners to AI hosting angle. Another was that several undercovered or thinly disclosed names have public quotes but incomplete data. Analysts recommend scenario analysis and waiting for filings before normalizing valuation inputs.
That's practical. When public data is missing or inconsistent, scenario work and conservative assumptions reduce the chance of surprise.
Quick transition to methodology and what analysts actually did in these notes. Alpha Research emphasized multi-metric triangulation. They used valuation multiples like price to earnings and EV to EBITDA, cash flow metrics like levered free cash flow, and capital structure indicators like current ratio and net leverage.
They also leaned on consensus-anchored scenario modeling, laying out upside and downside based on execution, regulatory events, or commodity moves. And they flag specific event catalysts as monitoring items.
Examples of practical monitoring. Watch semiconductor equipment order flow, data center leasing and hyperscaler announcements, clustered first quarter earnings prints and guidance shifts, and regulatory policy developments in healthcare and banking.
Analysts said those items are likely to drive near-term estimate revisions and re-rating opportunities.
Another short reaction.
Yeah. Absolutely.
On practical investor implications, informational only, the notes recommended focusing on capex and lease signals for the AI theme, on capital returns and balance sheet resiliency for income candidates, and using event calendars to bracket volatility windows around earnings, rate cases, or FDA decisions.
And analysts also highlighted watching ETF flow dynamics. They noted that sector ETF flows and futures-based ETF behavior can materially affect liquidity and correlated equity moves.
Let's pull out the week's top takeaways in plain language. 1. AI and data center demand was the dominant cross-sector narrative, lifting semiconductors, equipment, and data center real estate. But multiples are rich, and execution risk is high.
2. The market showed a clear bifurcation. Beaten down growth and cyclicals offered valuation resets and income, while premium AI beneficiaries carried limited margin for error.
3. Balance sheet metrics, buybacks, and dividend yields were central to relative conviction. Where companies lacked disclosure, analysts advised caution and patience.
4. The miners to AI hosting pivot is a real contrarian theme in some notes, but it's execution heavy. Watch lease confirmations and liquidity.
5. Near-term catalysts to watch are clustered first-quarter earnings, semiconductor equipment order flow, data center leasing announcements, and regulatory moves in healthcare and banking.
Those are the high information items that could reprice parts of the market quickly.
Final reaction segment.
Got it.
All right, quick wrap. The research cycle this week reminded us that AI is the dominant growth story, but it also reinforced that steady, regulated cash flows remain very attractive to many investors. Analysts emphasized company-level execution, capital allocation decisions like buybacks and dividends, and macro or regulatory headlines as the decisive factors for re-ratings.
And remember, the notes are data-driven and scenario-oriented. They're a starting point, not personalized advice. Consult your own financial professionals before making decisions.
If you want to dive into any of the individual notes we mentioned, the deep dives on NVIDIA, Eli Lilly, Globant, the semiconductor equipment suppliers, and the crypto pivots, head to stockalpha.ai. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be watching capex, leases, and the upcoming earnings prints next week. Same time, same place.
Thanks, Josh. And thanks to everyone listening. That's Alpha Recap for this week. Talk to you next time.